New study supports 100% equity investing for life. The debate. I'm recording this on Super Bowl Sunday, wearing red to support my team. And we have an interesting, a popular topic today. So I recently posted a video called New Study Supports 100% Equity Investing for Life that went semi-viral. It's had 14,000 YouTube views so far and 1,000 podcast downloads. So there's an interesting active debate, mainly on YouTube and a bit on my blog, with a lot of comments and questions. So let's look at them and join the debate. It's a really cool topic. Now, the evidence from the study to invest 100% in equities for life is certainly unconventional. So the comments revealed interesting insights. And it's an important topic. I've many posts on my blog over almost 20 years about how much better your financial plan and retirement income are with a high equity allocation. I have posts about other studies, including my own, supporting this. I believe people with high enough risk tolerance who will stay invested through market crashes should invest 100% equities for long-term investing. So this is unconventional wisdom, but studies show it works. And this new study is in-depth and confirms it. So what we're going to learn today is, what did the study say? It's just a summary. What did most of the comments agree on? Does the study support 100% equities right through retirement? So won't many people panic and sell? How does the recommendation of 67% international look for U.S. versus non-U.S. investors? Do international stocks provide good diversification? Would this work in some time periods but not others? Would it work for narrower equity indexes such as the NASDAQ? Is this study new? Isn't the risk of running out of money in retirement similar for 180 and 60% equities? And isn't it better to keep some cash? Okay, so the actual video about my study was a few weeks ago, and it's worth looking at that one separately. What I'm covering in this one today is the debate. I'm just looking at the comments that we got and my responses to the comments. So just covering the debate. So first of all, what did the study say? Just a quick review. The study reveals that an all-equity portfolio through your entire life, with 33% domestic stocks, 67% international stocks, 0% bonds, and 0% cash, outperforms traditional stock bond strategies in building wealth, ensuring reliable retirement income, preserving capital, and generating bequests. In all four areas, it outperformed these traditional, conventional wisdom bond strategies. In other words, 100% equities provided both a more comfortable retirement and a more reliable retirement. So now it compared this portfolio to both the traditional 60% equities, 40% bonds, constant allocation, which a lot of people advocate. I also compared it to the age-based allocations, such as 100 minus year age in stocks or 110 minus age in stocks. So these could suggest, 70% stocks at age 30 and 20% stocks at age 80. Now, the conclusion is that diversifying with international stocks was more effective than diversifying with bonds or cash. That's really fascinating. So now this research, backed by robust data from 39 developed countries and spanning long-term investment horizons, challenges two key investment conventional wisdoms. So one is that savers should diversify between stocks and bonds. And number two, that young people should invest more heavily in stocks when they are older. So it kind of debunks both of those. So I have links here that are for both for the study itself and for my video about the study. Suggest that you watch this video about the study maybe before you see this one. So now, what did most of the comments agree on? So first of all, because the many comments, the most common post was just agreeing with 100% equities. So a lot of people actually agreed with it. And let me just read a few examples. So one is, I have a pension and no use for bonds. I'm 100% S&P 500. Next one, I'm in the same boat. Equities all the way for the win. So next post, I actually already have an all-stock portfolio. And here's a funny one. Who would have thought having a 1% real return in a debt-based inflation economy over the long term is risky? I'm so shocked. So they're talking there about the 1% real return, which is kind of what bonds have had over the long term. So 1% above inflation. So, and the next comment is, follow this model and stay away from bonds. Now, it's not surprising that most of the comments were agreeing with the study. Many of these viewers, I think, probably have been following my prior posts. I've already been talking about how effective 100% equity investing can be. It's not surprising that was by far the most common comment. So now, does the study support 100% equities right through retirement? So here's one of the questions that a viewer asked. Might be wrong, but the study was over the life of the investor, not during retirement. Of course, a young person decades away from retirement should be 100% equities. Being in bonds for 60 years is definitely a drag. So my answer to that, the study shows results for life. It has a section specifically about 80-year-olds and how generally they are still best off with 100% equities. Note that this requires they are able to stay invested when their investments go down. The authors say this strategy is not safe, quote unquote, but it is safer than holding bonds or cash. Okay, another comment. Would you continue to take out 3 or 4%? They're talking about in retirement based on the 4% rule, even if the market is down, or use a home equity line of credit until the market comes back up. I'm retiring younger, so I'm wanting to maximize several decades of retirement income. I appreciate your thoughts. Thanks. Okay. Another question on the blog. So if an 80-year-old is 100% in stocks and we get another financial crisis, how could they possibly recover, especially when having to potentially sell stocks at low points every month to pay the bills? So my answer to that, we have direct experience with this. So we have clients that achieved their retirement goal and retired. So they had the portfolio that they needed in their financial plan. Unfortunately, it was summer of 2008. 6 months after retiring, their investments were down 40%. So this was the single worst case since the Great Depression. So what did we do? So in these cases, we just kept sending them the cash flow in their retirement plan. We monitored their withdrawal rate and in some cases reduced their income by $100 to $300 a month. In 2 to 3 years, they'd fully recovered. So note this was the largest market decline since the 1930s, and investors were fine if they maintained their plan. So as long as they stayed through it, they were still fine through that period of time. The next topic that we got posts on or comments on, won't many people panic and sell? That's a great question. So here's a few examples of comments. So one is, this is excellent for experienced investors who survive 20% drops. Average retiree will panic. Bonds are wonderful at smoothing volatility, thus reducing panic selling. Next comment, you can be an experienced investor, but surviving a 20% drop has more to do with current state and needs. So there he's saying it's more about your cash flow position than risk tolerance. So next comment, 100% in stocks is insane unless you don't need that money. The next comment, I don't agree with this study. 20% bonds to smooth out the ride, 20% international stocks, only in countries with hardworking people. Now, a question on this topic from a comment from a viewer. I actually already have an all-stock portfolio, but to play devil's advocate, the whole problem with this strategy is the fact that the vast majority of retirees absolutely cannot handle the extreme volatility of a 100% equity portfolio. There's a lot of evidence showing that most investors will do something dumb when they see huge declines in their portfolio, ruining any benefit that would have had if they stayed the course. The reason the classic 60-40 portfolio is so popular is because it's a smoother ride that the average skittish investor can handle, and that's nothing new, as that's not nothing. My response, you're absolutely right. So that's exactly an issue. So, and probably true of, I don't know if it's most, but yeah, quite possibly most investors, but at least a large number of them. So now the study does not say all equity investing is safe or that it's recommended, just that the people that do it for the long term will almost definitely have a more comfortable and a more reliable retirement. So their risk of running out of money is lower. My experience is that the risk tolerance is a learned skill. So many people can learn to tolerate significant declines. Risk tolerance is the ability to do nothing when your investments are down. That's really what it is. So with education about market history and probably working with a trusted advisor, people can learn to do nothing and ride through their investments. So if they can do that, then they are highly likely to retire more comfortably. So that is just from experience. I find a lot of people are more conservative investors because of lack of knowledge, not necessarily that they can't ride it through. So, but anyway, this has got to be an individual issue, but certainly that's an important factor in this. So the study shows that it did work, or has worked reliably, but as long as people will stay the course, and not everybody will. How does the recommendation of 67% international stocks look for U.S. versus non-U.S. investors? So some comments are from American investors wondering why they should not invest 100% in the U.S. So a few countries have had higher returns than the U.S., But the U.S. stock market has significantly outperformed the rest of the world index the last several decades, and U.S. stocks are 74% of the world index today. So growth in the world is mostly in only a few countries, including the U.S. So now here's how different the study looks for U.S. versus non-U.S. investors. So now if you look at the percent that would be in a home country, so for U.S. investors, the world index is 70%. They would have 70% in the US, but the study says only 33. So now you go to Canadian investors, the study says, the world index is only 3% that's in the world index, and yet the study says 33. So there's quite different situations there. And also, the US is a much faster growing economy than we are here in Canada. So now investing outside of Canada, this is another post with a little bit of fun humor in it. It says, investing 70% out of Canada, quote, US 51st state, is certainly good advice along with staying away from bonds. Another comment, I'm 70% international. I'm not from America, so I have about 70% there, LOL. So now a question on this topic for a viewer. Since international, in this case he means global, is 76% US for US-based investors, the 66% international and 33% domestic is the same as 50% US and 50% international. Now, the math here isn't exactly right because it confuses international and global, but it's kind of a point that US investors, it looks differently. So my answer to this, the study considers, international, quote unquote, to be stocks outside the home country for investors in each country. So therefore, US investors, 67% international would be 67% in Europe, Asia, emerging markets, America, ex-US, etc. So this is why I think the results should be taken as an average of all countries, not necessarily optimal for specific countries. The US is about 70% of the world's stock market and it's higher growth than global stocks. US investors might be best investing, 70% or more in the US, but keeping significant international diversification. So that's a bit different from the study, but I think that's probably what I would suggest for US investors. On the other hand, Canadian investors should optimally have a little in Canada since we are only 3% of the world's stock market and a lower growth country. So this would probably apply to many of the 39 countries in the studies. The average of all countries having 67% international might be optimal. That could be an average of 30% or so for US investors and 95% or more for investors in many countries. So that's my response. So now, just to be clear on this, so what we're fee-for-service financial planners. We look at all that planning. We don't do the investing. We just look at the asset allocation specifically, and we found it's being 100% equities or very high equity, as much as you can tolerate, is very effective for most investors for planning and for retirement savings and for providing a retirement income. But all our really issue is that you should be broadly diversified in good company. So we're not making specific recommendations here on what somebody should hold, but we're just looking for how do we get broadly diversified in something that we think should do well over the long term. Okay, next question on this topic. I think Ed would agree with my strategy to have 5% Canada instead of 30% Canada. My answer, the study recommends 30% in home country as an average for all countries. I believe this is way too high for most countries. It is averaged up by US investors who probably should have more than 30% in their home country. For example, Canada is only 3% of the world's stock market, and we are a lower growth country with a non-diversified stock market. Independent portfolio managers we work with have virtually nothing in Canada. So that's, we find these top investors for our clients, and they end up with almost nothing in Canada when you're really looking globally. So another comment on the blog. So if you go through the tables near the end, they show all the 39 countries they used in the study and how many years of good stock market history they have for each one. So that's my comment from about the study. Okay, next topic. Do international stocks provide better diversification than bonds? So here's a couple of questions from the blog from viewers. So one, 67% in international stocks. Wow, I didn't see that coming. I'm almost 64 years old and I'm 100% in low-fee stock index fund, including only 15% in foreign or emerging markets. So have been debating with myself whether I should diversify into bonds. This study certainly complicates things. So see, I'm hoping to clarify things for people, but this complicates things for him. So another is a question, but actually comments on the last one. So the comment is, at age 64, you have 85% invested in U.S. market. That is risky. It is likely you are putting all of your eggs in one basket. You are not well diversified across the globe. If you read the book by David Swensen, who was in charge of the Yale investment portfolio, known as the Yale model, his diversification process is in line with this study. He says, I lost about 80,000 when the U.S. market dropped 22% in 2022. This is why proper diversification is essential. So my answer to these questions, basically, did you stay invested after the decline in 2022? Like, he sounded like it was a big problem, this 22% decline. And interestingly, is like for 100% equities, 22% decline is, significant, but it's not nearly the biggest decline that you'd get. But that's the one he seemed concerned about. So I said, did you stay invested after the decline in 2022? If so, you probably did not lose anything. The stock market has historically recovered from all declines eventually, with 88% of declines recovering fully in 1 to 2 years based on history. So, all right, next question from a viewer. So you are correct. I was fully invested. It is when you sell that you actually lost money. Thank you for the feedback. My answer to that, so this study improves on past studies by looking at 39 developed countries, solving some issues such as survivor bias, and looking over a typical full retirement of 30 years. So that's why it's a more in-depth study than pretty well any other study I've seen on this topic. So the Yale study was only US, but still has similar conclusions. It's interesting that this guy quoted David Swensen, because I quote David Swensen in my email signature. So my blog is, Unconventional Wisdom. It's unconventionalwisdom.ca. But my email signature includes, to have unconventional success, you can't be guided by unconventional wisdom, which is a David Swensen code. All right, another comment on this topic. You should also know that international funds in stocks yield more than bonds. Bonds does not account for inflation. Minus the average 3% inflation rate from the total return from international stocks, you'll get an average about 8%. You can't beat that. So that might be a long-term average, but it's kind of true. Like, international stocks in general tend to have a bit higher dividends. So much of the time, just the dividend alone would be higher than what you get from bonds. Next question from a viewer, why stay away from bonds? The answer is bonds barely keep up with inflation long term, so they add hardly any growth. They are not reliable long term after inflation. From 1900 to 1982, bonds made zero after inflation. So that's 82 years with zero return. That's 82 years. So from 1940 to 1980, bonds lost 50% after inflation, after 40 years of investing, So you had money to buy 2 cars, you put it in bonds for 40 years. After 40 years, you can only buy 1 car. You've lost half your money. So bonds have had truly horrible periods that last 40, 60, 80 decades sometimes. It's crazy. Now, the standard deviation of bonds after inflation is higher than stocks for periods of 20 years or more. That study's on my blog. Bonds are steady short-term, but not reliable as a long-term investment if there is any inflation in that period. So, and if you're in for 30 or 40 years, most likely there's going to be at least some high inflation period in that time. So inflation being as high as the yield happens very often. Again, from 100 to 1982, bonds made zero after inflation. Next topic that there were comments on, would this work in some time periods but not others? And there were a few variations of it. So here's a couple of comments. That's been great for the past decade or so, but it wasn't always the case. Surely it's wiser not to put all the eggs in one basket. Another comment, what will you do if the market crashes and S&P 500 index goes down by 50%? Or just like about 2000 up until 2010, the US market produces negative returns for a whole decade, a bear market for 10 years. Next comment, I think bonds have been in a peculiar situation in recent years. When in the past were interest rates so low as they were in the past decade, that sent bond prices way up, and the interest rate rose to make historical rates. That sent bond prices crashing. I'm resolved to not own bonds if we have an interest rate of 2% or lower. So this guy is thinking he's going to follow the study overall, but only if the interest rates are really low. The 100% equities from the study. So the U.S. equity market, here's another comment, the U.S. equity market underperformed from 2000 up until about 2010, a whole lost decade. So if you'd put a lump sum of the market, say S&P 500 index or total U.S. index in 2000, it would be worth less than 2009. Including reinvesting dividends, it would still be worth less than when you initially invested in 2000. And this equity bull market since 2009 is the longest bull market in recorded history. So this definitely isn't normal. So he's saying it will work sometimes and not others. So now my response to these comments, this study showed that the returns were higher and risk of running out of money was lower over your lifetime, including right through retirement. It improves on past studies by looking longer term over the time of a typical retired couple, like over their life, by fixing data issues such as survivor bias and by including long-term data from 39 different developed countries. So it's not just the US. It did not work 100% of the time, but far more often than the conventional wisdom using bonds. Next topic of questions, would it work for narrower equity index such as the NASDAQ? So, and here's a couple of comments. So one is, Bill, thanks for the review of the study. As it turns out, I just read the study yesterday and happened on your review of the study today. I have a question that I haven't seen anyone address. I know that the study only focused on stocks, bonds, and short-term bills because of data availability. However, I'm curious how the conclusions might change if one were to include alternatives like real estate, private equity, private credit, infrastructure, commodities, etc. in the mix. Do you think that real estate, infrastructure, private credit could change the conclusions at all? And if so, in what ways? Another question kind of related to that question is, what's your opinion on investing long-term, so 20 plus years, in NASDAQ versus S&P 500 for retirement? You mentioned that equities became less risky with time compared to bonds. Does this principle hold true for different indices? High returning equities become as risky as low returning equities. So over the long term. So it's just like stocks become, the risk of stocks is much lower over 20 and 30 year periods than over a 1 year period. So he's asking is, does that apply to, narrow indexes like the NASDAQ? So my comment, the studies that show equities long-term have been more reliable than bonds are all about broad markets such as S&P 500. So I've not seen similar studies for narrow indexes like NASDAQ. So I can't give a definite answer here, but it may or may not be true. I did read a study years ago about the Nifty 50. So that was a bunch of high growth stocks in the late 1960s. There was a large bull market. They declined a lot and struggled for many years. However, 30 years later, they had outperformed the S&P 500, even if you bought them at the very peak. So I'd suggest that more focused indexes like the NASDAQ are likely to outperform the S&P 500 long term, like if they're higher growth indexes, but with a lot more volatility in both directions and probably more uncertainty over the long term. So, my guess would be that over a 30-year retirement, the success rate would be lower with something like the NASDAQ, but would be what I would think is probably true. Other ones, like most of these, when the guy was talking about real estate and private equity, private credit infrastructure, most of these are types of equities. So it is kind of, diversified for that. Some of those are thought of being as lower risk, like lower volatility, but the ones that are lower risk are generally lower return as well. So I'm not sure that all of those would actually help. My guess would be they might make the success rate lower, but this is just a guess. Okay, next topic is, isn't this old news? The study came out in November 2023. So my answer, no, this study is new. It was published December 2024. It's a higher quality than past studies. All right, next topic on this, isn't the risk of running out of money in retirement similar for 100%, 80%, and 60% equities? So this kind of astute investor pointed out, so at 12:58 in the video about my study, it's pretty clear that 80-20 or 60-40 stock to bond ratios have similar risks of running out of money at 3% or 4% withdrawal as 100% stocks, like through retirement. I suspect the study is warning against very heavy bond ratios of 40 to 60 stocks to bonds, as some of these timed ETFs have. I am retired at 57 with a roughly 70-30 stock to cash plus bond index fund ratio. I don't believe that chart shows that I have a higher chance of running out of money. So that's the chart that I have on that other video. I'm happy with that ratio because of the possibility of a downturn in the future. I expect one significant economic downturn in retirement and have to prepare for that mentally and financially. So now my answer to this. So my study about the 4% rules shows that it had a 96 to 97% success rate in history for portfolios with 70 to 100% equities. 80 and 60 was somewhat lower, or it was a bit lower. So for higher withdrawal rates, such as 5%, the highest success rate has been portfolios as of 90 to 100% equities. So this implies that higher equities is likely more reliable over a 30-year retirement in more extreme markets. Of course, the higher the equity allocation, the higher the long-term returns on average, with the same risk of running out of money. So my study that showed, the 4% rule showed, like 80% versus 100% stocks is essentially basically the same risk of running out of money. However, at the end of 30 years, you have a lot more money, so you have more comfortable retirement and a bigger estate with the same risk of running out of money. So the study just shows that what has worked over time for most long-term investors, you can make market timing calls like you are if you want. Next topic on this issue, isn't it better to keep some cash? So the question that I got from a viewer, I'm curious your suggestions for withdrawal in retirement. I know in other articles you've mentioned not keeping a cash wedge. So this one is actually on my blog, this comment. So my answer is, the study I had it's called How to Reliably Maximize Your Retirement Income. Is the 4% Rule Safe? I have a link to it here on this post. So it showed that holding cash has never helped any time in the last 150 years. There has never been a case where someone ran out of money during retirement with 100% equities that would not have also run out of money with a cash holding of any size, small or large. Cash holdings over 30 years have always had lower returns than stocks, which has been a more significant factor than using the cash through market declines. All right, so those are the topics. Now, your chance to join the debate. So what do you think? So there's comments there on YouTube and on my blog, so join in. So is 100% equity investing for life, including right through retirement, with 33% domestic stocks, 67% international stocks, 0% bonds, 0% cash, an effective portfolio for you? What do you think? So my view for investors in Canada is that investing globally with almost nothing in Canada, say 0 to 5% in Canada, and a high amount in the US is the most effective for both building your portfolio and for providing a reliable retirement cash flow for you, as long as you will maintain your plan and allocation through market declines. All right, so that's my talk this week. You learned, what did the study say? What did most of the comments agree on? Does the study support 100% equities right through retirement? Won't many people panic and sell? How does the recommendation of 67% international stocks look for US and non-US investors? Do international stocks provide good diversification? Would this work in some time periods but not others? Would it work for narrower equity indexes such as the NASDAQ? Is this study new? Isn't the risk of running out of money in retirement similar for 100%, 80%, and 60% equities? And isn't it better to keep some cash? So those are what we talked about. So thanks for listening. So my name is Ed Rempel. My blog is Unconventional Wisdom. So it's the #1 blog in Canada for a full-service financial planner. So you can find my blog, it's just edrempel.com, or I have a YouTube channel, edrempel.com/watch, and podcast, edrempel.com/listen. Feel free to make comments, and if you subscribe to them, all that means is you will get an email once a week with all my new posts. So we don't mark it in any other way, but that's all it'll say. So thanks a lot for listening, and we'll talk to you next week.